Hey everyone, happy Thursday, September 4th. It's a little after 9:20 on the West Coast, and it's time for another market update. Over the last few weeks, we've been on a nice little trend downward with mortgage rates, which is great to see. As we get closer to that September meeting coming up in a couple of weeks for the Fed, it's going to be even more important to look at the data. And so far, so good this week. But first thing I wanted to start off with is tariffs. So you might have seen the other day one of the appeals courts ruled against the tariffs, saying President Trump, basically went above his abilities to implement these tariffs. So now they've been asked, the Supreme Court's been asked to review the case. So it's going to go to the Supreme Court now. So we're gonna have to see what happens there. Which would be best for mortgage rates? It's kind of hard to tell because if they reverse we didn't really like the tariffs to begin with because they can be inflationary. But if they reverse the tariffs, they've already collected money, so the government would have to pay that money back, and that usually means issuing new treasuries, which means the government's paying for it, which generally is not good for mortgage rates. So that would be the only take I have on that is if they have to pay the money back, that won't be good at least in the short term. So we will have to see what the Supreme Court says. Next thing we got. So first big piece of important data going back to last Friday, we got July's PCE. This is the Fed's favorite form of inflation to take a look at, but it's also kind of dated because we get CPI a couple weeks before this, and so we kind of know. Chairman Powell, when he was in Jackson Hole, even mentioned he knew this would go up to about 2.9% core, and that's what happened. The core went up about 0.3% as expected. Headline up 0.2. That brings us to 2.6% for the headline, and then 2.9% year over year for the core, which takes out food and energy costs. So again, it wasn't a surprise. It seemed like the Fed had already built that in, knowing tariffs were going to kind of show up a little bit here. So obviously, we want inflation to come down, but overall, this wasn't a bad report because again, it didn't surprise the markets, and that's the worst case scenario if we get a negative surprise. Next thing we got. So it's jobs week right now. It's very important. Two biggest things: inflation and jobs. So we got going back, a couple days ago, we got the July JOLTS report. So job openings in July. So it's a little more data. We're gonna get August. We got August ADP today. We get August BLS tomorrow. But for July, JOLTS came in only at 7.2 million currently, and as you can see, going back to May of 2022, is at over 12 million, and it's been on a steady drop down. And also, there tends to be double counting with these jobs. So we don't even know if this 7.2 is legit because a lot of companies now double post jobs on LinkedIn and things like that for, same position if it's remote, but they're posting as individual postings in each state, things like that. So not good that the labor market seems to be weakening, not solid like Powell said. But however, anything that shows the labor market weakening is good for us because that kind of solidifies the Fed rate being cut. So it is declining. Healthcare and social assistance was down 181,000 jobs. Leisure and hospitality down 47,000 jobs. Keep that in mind for a second. And retail trade down 110,000 jobs. So again, it's kind of our first look. When companies stop hiring, there's less job openings. It's usually a pretty good indication that the job market is slowing. So that was the first one we got. Second one we got today was ADP. So this is private payroll for the month of August now, not July. And this came in lower than expected. Came in at 54,000. Estimate was 75,000. Previously revised, so they a little positive revision to the previous month. Kind of spread out. The gains were spread out across the board between small, medium, large businesses. But look, leisure and hospitality was up 50K. So in July, according to Jolts, that dropped by 47,000. But for ADP in August, it supposedly added 50,000 jobs. So not a lot of consistency across these. It'll be interesting to see what the next BLS jobs report that comes out tomorrow shows for leisure and hospitality. So overall, again, showed weakness. Markets like this because not that we want people not to have jobs or not have jobs available, but the slower the job market looks and the flatter inflation stays, the more likely the Fed won't just cut coming up in September, but they will continue to cut to stimulate the economy. And the more they cut, the lower mortgage rates will kind of tag along, not perfectly with them, but we'll tag along and kind of drift downwards. So again, overall good that we saw some weakness here. However, the big one will be tomorrow when we get the BLS jobs report. That's the biggest report. That's been the killer. We've been right here before where rates are about to drop. Everything looks good. Like rates are going to continue to drop. And then we get a BLS jobs report that's crazy high. And then the markets do not like it. So we'll have to see what happens tomorrow. Next thing in employment that we got this week was today, initial jobless claims out. They ticked up a little bit again to 237,000. Continuing claims still remain really high. But there's a lot of the ADP report came out today, and they're saying basically over the last couple of years, people are working two less hours. than they were prior to the pandemic. So again, it's not job loss, it's less hours. So that affects people's pay just as much as losing a job. So basically underemployed, not unemployed. So that's again showing up like, oh, there's not a lot of layoffs, but people aren't working as much either. So less money, they're doing less well. So again, just another sign that the labor market looks like it's slowing down. Where does that leave us? We're down to 6.45 this morning. 6.5 last week. Yesterday, when it ticked down to 6.49, and this is going to sound a little sad, but that was the lowest mortgage, conventional mortgage rate according to this lender survey in over 11 months till October 3rd, I think. Right before we got a bad BLS jobs report that kind of set us, back and pushed back up towards 7. So again, down to 6.45, lowest in over 11 months now, but it's still good to see the positive movement down. Still see it ticking down. I'm sure a lot of people want to see it go lower than that, including myself. But keep in mind again, though, if the lower rates go, the more demand will tick up because there's a lot of pent up demand right now. So if you wait for rates to drop even further, there's a good chance then prices are up. So it's hard to time the markets perfectly. So you got to keep all that in mind. So the next thing we got. So tomorrow, like I said, we get BLS jobs report. Right now, they're expecting 75,000 jobs created. Unemployment to tick up from 4.2 to 4.3. If neither of those happen or both those happen, or a combination of that, basically just the less jobs are created, the better. The higher unemployment ticks up, the better as far as mortgage rates go. And the next week we get after that, we get a CPI for that will be end up being August inflation, and then the Fed meets on 9/17, so we're a little bit under 2 weeks away. Right now, it's a 95% chance they cut, but again, it's been kind of baked in that they were going to cut for a while now. It's more about what they say at that meeting about the next cut, about October meeting, about I believe December's meeting. We want them to cut in September and then keep cutting. So we'll have to keep an eye on data and see what happens there. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great rest of your week, guys. Thanks a lot.